आइए और आने वाले कल को आज देखिए बताइए कि वक्त को देखना कैसा लगता है।
Hello friends, I am Vikash and I have an important message to convey. Since lockdown there has been increase in number of Demat account open. So is opening of Demat account and doing investment in stock market not advisable? Yes, it is advisable, but the investment should be used for wealth creation, not for wealth destroyation. I have gone since past I have researched many people invest blindly, like without doing research on their own, just listening at somebody's advice, and they invest blindly that their money will be double in the stock market. That is not actually correct. You should do your research by your own. You should have the analysis why there is a price fluctuation, and after taking all the consideration into factor, you should keep your hard-earned money in a proper place where it will give you a wealth creation, not a wealth destroyation. Okay, let's see today's topic. Today's topic is one of the interesting topic that is covered in the stock market, like what is the futures and option that are traded in the stock market. So today in this video I will be covering what is future and option. So before covering what is future and option, we need to go a little bit backward, like we need to understand what is derivatives. So today I'll be covering what is derivatives, why people do invest in derivatives, like why it is one of the commonly used by many of the pro investors, like many of the people investing in regularly in the stock market, and what are different types of derivative that is available. So I will be covering the three topics today, so let's check it out one by one. Okay, before starting, if you are new to the channel, do hit the subscribe button and do hit the bell icon for early update on this channel. Let's see what is derivatives. Derivatives is a financial contract whose value is dependent on underlying assets or a group of assets. Confusing? So let's make it simpler by using some of the example. So let's take for example a furniture which is produced by using the woods, like using the woods that is used for making the furniture. So the underlying assets here would be wood, like wood will be underlying assets and the furniture will be the derivatives of it. So as the value of the wood increases, the value of the derivatives would also increase. In the same way, as the value of the wood would decrease, the value of the furniture would also decrease, depending on the condition how the value is fluctuating. Okay, let me think of the second example. Like second example could be the example of gold. Like by using gold we make jewelry. So when the value of the gold increases, the value of the jewelry automatically will increase, because gold is the underlying assets here. Gold is the underlying assets and the jewelry is the derivatives for the gold. So when the value of the gold increases in the market, automatically the value of the jewelry will increase. So that's the okay. Now let's check some example of the financial terms which I use, like the derivatives which I use in the stock market. So let's take for example Nifty 50. Nifty 50 is one of the commonly used indexes. So let's take, when the value of the Nifty 50 increases, the value of the Nifty 50 derivatives, like Nifty 50 will have a derivatives which is trading in the stock market. So when the value of the Nifty 50 increases, the value of the Nifty 50 derivatives will automatically increase. So there is a relationship between Nifty 50 and Nifty derivative. So here what will be the underlying assets for Nifty 50? Nifty 50 derivatives. Nifty 50 is the underlying assets for Nifty 50 derivatives. So when the value of Nifty 50 decreases, the value of the Nifty 50 derivative will automatically decrease. Okay, let's see why people prefer investing in derivatives. One of the commonly reason, like looked by every investor in investing in derivatives, that it provide a leverage. Leverage in the sense means it provide a margin. For example, a share which is trading in the stock market, like the shares which will have its derivatives which is trading at 100 rupees, we just need to pay 20 rupees or 40 rupees per share to get 100 rupees share. Means you don't need to pay the full amount, we just need to pay a portion of the margin. Like different company shares or derivatives will have different margin depending on the SEBI guidelines. So for example, I have just I just took one example, like for 100 rupees share we need to pay just a nominal amount. So like for 100 rupees we need to pay 20 or 40. So that is always advisable, because paying less and getting big quantity of shares, like for buying 100 rupees of shares in regular without using derivative, we need to pay 100. But when you're buying the derivatives of it, we need to pay only 20 to get 100 rupees of share. So that's actually one of the advantage, and one of the biggest advantage why people prefer in investing in derivative. Let's see what are the different types of derivative. So the different type of derivative is categorized in the four major categories, that are future, option, swaps and forward. So future and option are traded in the stock market, and these swaps and forward are not traded. These are traded over the counter, means these are privately held by individual. This future and option are widely traded in the stock market. So let's first check it out. What is this forward and swap? So first we'll be seeing what is forward contract. Okay, forward contract is a contract under which the two party comes together under an obligation to perform a contract at a future period date as a price agreed now. So is it confusing? Obviously it is confusing. So now let's understand with a simple example. Okay, let's understand this forward contract with a simple example. There is a farmer who is engaged in agriculture activities of producing a potato. So he is actually worried that at a future date, when he would go to the market and sell this potato, the price will decrease, as there would be a huge supply of potato at that time. So in order to gain some profit on the agriculture produced by him, he entered into a contract with a wholesaler dealer who is engaged in buying the potato. So when the wholesaler, he entered into a contract that depending on the term and condition, that whatever the price may be ruling in the market, he agreed that he would be selling 1 tons of potato for 1000 rupees. So he would be selling, depending on the agreement they entered into a contract, like he would be selling 1 tons of potato for 1000 rupees. So after 3 months, so after 3 months, if the price in the market is also, if it decreases to 900, the wholesaler dealer is obligated to buy the potato at 1000, because 1000 rupees, because the contract has been entered before, like it has been agreed between both the party. No matter what will be the current market price, I am obligated to buy at 1000 rupees. So depending on the price fluctuation doesn't affect the farmer. He is obligated to sell at 1000, and the wholesaler dealer is obligated to buy this potato at 1000 rupees. So that's how the forward contract function. Like it is a financial contract which is entered today, the price is agreed today, but perform at a future date. Let's see the second type of derivative contract. The second type of derivative contract is swap. Swap is also a derivative contract, but this is actually not traded in the stock exchange. It is traded over the counter, means it is privately held by two party involved in the transaction, two or many party, depending on how the swap contract is obligated to perform. So what is swap? Swap contract is a derivative contract in which two party enter into to perform a financial obligation. So what's financial obligation and what's this swap? This also we need to understand with us one simple example. Okay, let's understand this swap with a simple example. For example, Mr. A has he took a loan from SBI that gives a fixed rate of interest. Like he need to give on the loan given to him, he need to pay a fixed rate of interest. And there is another party, that is Mr. B, who has taken a loan from HDFC, but he need to pay a fluctuating rate of interest. Fluctuating means the rate of interest will be varying, like it will not be fixed. So both the party comes under a contract, like Mr. A and Mr. B enter into a contract, like they exchange a financial obligation. Mr. A would be paying the interest amount for Mr. B, like Mr. A will be paying a fluctuating rate of interest to HDFC Bank, and Mr. B would be paying a fixed rate of interest to SBI Bank. So both of them, when they when they exchange their financial obligation coming into a single contract, that is called swap. As we have seen the two derivatives contract which are not traded in the stock exchange, and we have understood what's how they function and what are the difference between these two. So now let's check it out. What is the other two derivative contract that is that actually trade in the stock market. So one of the derivative contract is future contract. So what is future contract? Future contract is same like a forward contract. As I explained in that example, there would be a farmer who is under an obligation to perform a contract to wholesale dealer. So future contract is the same as a forward contract, but the mere difference here is that the future contract is traded over the stock exchange and forward contract is privately held over the counter by two individual to a party. So future contract is a so the mere difference is future contract is a standardized document, like there is obligation to perform. There can be a breach of contract in forward contract because there is no regulatory authority dealing with in the forward contract. But in future contract there is a regulatory authority, like it will be happen over like the trading will take over the stock exchange. So there would be a regulatory authority, SEBI. So so there is an obligation to perform the future contract. So how does future contract like function? Okay, let's understand the future contract with a simple example, taking into consideration the current scenario. Like for example, there is a company which make a hand sanitizer. So it makes a hand sanitizer, so it requires raw material of alcohol. As alcohol is used in making of hand sanitizer, so it requires raw material. So it gets into a contact with a supplier who is engaged in supplying alcohol which is used for making hand sanitizer. So as the current scenario, the prices of hand sanitizer is been increasing, like the market of hand sanitizer business is booming. So indirectly the prices of alcohol that is used in making of hand sanitizer would also increase. So this company which make a hand sanitizer, that is company that make a hand sanitizer, and enter into a contract with a supplier that is engaged in supplying alcohol. They enter into a contract that no matter what's the current market price, I would be buying alcohol which is used for making hand sanitizer. Company says I would be buying alcohol that is used for making hand sanitizer no matter what is the current market price. I would be buying it like for 1 liter I would be paying it 50 rupees. For example, I'm just thinking for example 50 rupees. So the company enter into contract. So the supplier is obligated to pay obligated to supply 1 liter at 50 rupees. So if in future they enter into contract for 3 months, just for example they enter into contract for 3 months. So if in future after 1 month, like for when they enter into second month, the price of alcohol in the current market price has increased, like for 1 liter other dealers other supplier who are dealing in alcohol are supplying it at 80 rupees. But the supplier who is enter into contract with the company, he would not be obligated to supply at 80 rupees because he has already entered into a financial contract at supply at 50 rupees. So he need to supply the alcohol that is used for making hand sanitizer at 50 rupees, not at 80 rupees. So what's the company gain here? 80 minus 50, 30 rupees per liter is the company gain. Same way, if the price decreases of alcohol, for example if it decreases at 30 rupees, but the company has already entered into a financial contract with the alcohol supplier at 50 rupees, so the alcohol supplier will supply not at 30 rupees to the company, it will supply at 50 rupees. So here who is making profit? Company or supplier? Obviously the supplier is making profit because the current market price of that alcohol is 30 rupees, but it is actually supplying to the company at 50 rupees. So the notional gain, that is the profit, would be 20 rupees per liter. So that's the simple example. I think so you have understood how the future contract functions. Derivatives contract is one of the actually confusing but actually one of the interesting topic. So we will be covering this topic slowly, step by step. So today I have covered what are the different types of categories of derivative contracts that are available what are the different categories of derivatives. So I have covered the 3 derivatives contract, like forward, swaps and future, except option. Option is one of the vast topic, and even future is also a vast topic. So I would be covering this in the other series of derivatives topic. So that's all in the basic of introduction of the futures and option. Hope you have understood today's video, and do share this video with the people who is interested in making money out of investment. Thank you for watching. Bye bye.